Welcome to The Derivative by RCM Alternatives, where we dive into what makes alternative investments go, analyze the strategies of unique hedge fund managers, and chat with interesting guests from across the investment world. Happy birthday to me. Well, tomorrow, but if you can't wish yourself happy birthday, what's the point of even having a podcast? Speaking of, we've got some good pods coming in May. We'll be riffing with Resolve about return stacking, talking prop trading and vol surfaces with Noel Smith, and getting into wine and entrepreneurship with Anthony Zhang. So make sure to subscribe and check out those upcoming shows. This pod was super interesting, digging into the quirky quant details with Artur Sepp, head of systematic solutions and portfolio construction at Sygnum Bank in Zurich. We chat about his days at trend following firm Quantica and research into quicker and quicker information flow affecting returns, his work on volatility modeling, and why the data and testing and quant approach in crypto is both infuriating and fascinating all at once. Send it. This episode is brought to you by RCM's Outsourced Trading Group, where their 24/6 trade desk do call-ins, spreadsheet, FTP, direct-to-exchange, algos, and more. Order types to help firms be cost-efficient and not have to staff their own trade desk. Check it out under the services/trading firm/24-hour desk on the main navigation at rcmalternatives.com. Now, back to the show. All right, everyone. We're here with Artur Sepp, live from Switzerland. What part of Switzerland, Artur?
Hi, everyone. I'm based in Zurich.
Zurich. All right. And I got to ask, what's this little painting or drawing over your left shoulder there?
Well, it's something. It's from Chagall. It's a favorite painting of my wife.
Perfect. I love it. You're saving up to buy the real one?
Maybe tokenized share.
One day.
One day.
So let's start with telling us just a little bit of what it's like to be a quant. I think most people think of them as sort of the data character from Star Trek. Not sure if you're a Star Trek fan, but it seems like you're not all Android there. So what's the quant life like?
Mm-hmm. Well, it's a hard question to answer. I think, it's for me, it's more lifestyle, right? Relationship to my profession, right? I'm quant by profession. What it means is that I'm tempted to look at things in a broader scale. It's for me, it's more interesting to build up a system of how and why things happen, right? And therefore, it's idealization, it's abstraction, right? It's what I like in mathematics, right? I'm not married to math per se, right? It's just part of my profession, part of what I can deliver working in the larger teams, where some people, they tend to be more, say discretionary or more, say, intuitive.
Yeah.
And here, I stick to a model. For me, I think the key of being a quant is really to have a systematic way of looking at things, and to be able to answer question why.
It seems just the modernized version of the word engineer, right? You're just a...
Yes, exactly. I actually, for me, it's the same. I have a degree in industrial engineering from Northwestern University. So I studied several topics, and for me, it's always it's creating a system that can work through different cycles, that can work through, say, process different data sources, different parameters, and in the end, it's produce some utility.
Right, and I think that's the main engineering carryover, is kind of to make it last too, right? For more than one purpose, to exist in more than one environment.
Exactly. Yes. Actually, with this profession, what I like is almost I think I noticed already through I changed a few firms, few companies, but more or less what I do is the same. It has different names between, say, crypto, volatility, CTAs, but more or less it's it's almost the same. Not almost the same, but it can be attacked or approached with the same set of tools and set of approaches.
And have you coded in the same language that whole time?
Well, that's it's a good question. Actually, it's changed. So since when I just started early 2000s, it was C++ was predominant, right? And C++, to tell you this, C++ is almost like probably, I don't know, Latin language, right? It has it has everything. But if you process it, you understand. I think it's more about architecture, how make things scalable, what is important. And right now, of course, most of time now I work with Python. It's simpler, right? But idea, I think when we talk about programming, ability to put mathematical formulas and data into code is a skill that does not depend on language. Something that you have to learn, right? All quants, especially the ones that once you work in industry, in asset management, but it's say language. It should not depend on language you choose.
Yeah. And what came first for you, the interest in the statistics and probabilities and math, or the coding skill?
Actually, it's a good point. Actually, as an undergraduate, I studied finance and economics. It was like very quantitative, right? But then we studied modern portfolio theory like Markowitz and Black-Scholes. And at that time, I started to I was very curious because those were mathematical models that you could implement in that time in Excel and VBA. But then over time, I thought that it's very interesting. It's why I went to graduate program in statistics, but in between I got after that I got PhD and I got 3 master's degrees. And yes, indeed, through all time I did coding. I think it's important as say more people with applied say background. You always mathematics is one way you make a hypothesis, you can create nice theories, but in the end to apply things in practice, you need to do some experiments.
Yeah.
Right? And the experiments, it's using data and like running some outputs. And therefore, I think programming skills are important, and everyone nowadays, everyone who plans to get some sort of science degree should take enough time to learn this.
Yeah, but it seems to me we're at a bit almost at a tipping point, right? Where you have some of these no code platforms and things where the code can kind of create itself, especially like you said, for some of these math equations, that seems like a simple plug-in, for lack of a better term, right? Are we going to get to a point eventually where the coding is less important and the more important part is knowing how to apply and do the different testing and the different models on it?
It's a valid point. I think yes and no. Nowadays, what I see in candidates, like say the one that I interview, most of, especially these data science guys, they know how to use particular, say, Python package, right? As scikit-learn or TensorFlow. What I think they're missing this understanding of why actually,
yeah,
under what conditions you expect something to work, what are numerical representations, right? What the say conversions, how would you analyze the conversions of your algorithm? So therefore, and especially also in say in production, right? I can do something for experiment. I can take plug and play solution, but usually it's very limited. It's limited almost. It's limited to work in 95% of cases, right? All this is in the end is mathematics. It's a complicated, fairly complicated algorithms. Yes, it's very simple to use for some, say, nice problems, but the ones that we have in finance, you always almost hit that 5% that you have to think yourself a little bit how to tweak it.
Well, if that 5% can put you out of business, it's important. Moving on, can't have you on and not talk about trend, given what's going on in the world right now and given your time at Quantica. So part of me feels bad for you, right? You left Quantica in August of 21, which is right around the time trend started to go vertical. Do you look back and say, whoops, I shouldn't have left? Or do you see and kick yourself, or it's all good?
All good. There are 2 points. So first of all, like CTAs, in particular, trend following CTAs cannot be timed, right? So
yeah. Don't try.
You can enter, you can leave, or you can enter them all the time. Like you cannot say, oh yes, I left at that time. But I actually, so yeah, of course, when I exited this before that, and actually last year, what was interesting, last year was very similar to this year. So almost also was short trend, like rates rose, right? We had a correction in rates. So all CTAs were short bonds, long commodities, agricultural especially, and flattish equities. But then around May, it's all went out, like it's all corrected, right? Trend reversed. So I wouldn't say that I went, like almost say, I can say I left at the local peak.
Got it.
And the second point, I have my own portfolio that more or less is CTA based, and
okay.
So I still participate, and I think trend following for me is one of the best systematic strategies. It fits my mentality, and I like, say, in terms of diversification, in terms of say return potential, and say skewness.
Yeah,
it's one of the best stuff is out there, and I think for me there is no way I can kind of exit this, right? So I'm still...
Well, now it seems you have the best of both worlds. Like you're not dependent on it for your paycheck and for your investments. Now you can have some diversity in your exposures, right?
Yes.
So what was some of the most interesting trend research you did there? You were head of research, right?
Yes. So
you got any good stories of some of the cool stuff you did?
Yes, it's definitely interesting. As I said, CTAs is an interesting business because you have data, right? You conduct like
tons and tons
of
data.
So, for example, for crypto, right? You have most cases is like 2-3 years of data. And here we have data since, say, even tradable data for commodities since 1960s, right? And my research, one of the interesting parts, and also in line with our peers, is to see the deterioration of trend following since the 70s, 80s, 90s, and what are implications? So in 70s, 80s, even you had a transaction cost very high, you could run a short-term trend following system, meaning that your holding period on average would be maybe 2 weeks, less than 1 month, right? And you had stellar performance. It almost was like an alpha strategy. It traded turnover was high, transaction costs were high, but the statistical nature of markets, where you had these self-feeding cycles, They generated performance, say, depends on specification, but say between 2 and 3 sharp, right, up to mid-90s.
Yeah.
Then, of course, professional CTAs started. The bigger guys, they started to enter the market around 90s, right? You had bigger players. Then, of course, it started to deteriorate. And the way to respond is, of course, to increase the trend, the scale. So your holding period would have to be around 1 month.
Increase your holding period.
Exactly.
Yeah.
Increase in some way, it's increasing the decay rate of your signal, right? So the decay, you always take some sort of a look back. Depends on what weighting you use, but you always depend on some history of, say, one week. Ideally would be 1 week. Then you can adapt fast, right? If these conditions persist, you would adapt fast.
Well, that's interesting.
Unfortunately,
real quick, if you're thinking of it in like terms of bars, right? So if I'm trading daily bars and the signal deteriorates after 500 bars or something, if I'm trading monthly bars, that's 500 months. I've greatly expanded the time till deterioration.
Yeah. And it is also a good point. So with bars, you can think also how bars, like say, week over week, right? Ideal for trend following if bars kind of increase, right? You have a stair, they go up,
lower lows,
right? Yes, or down,
or right, vice versa. Yeah.
Right? And what happens since 2000, and especially over the last decade, market change, right? You have like, say, market takes elevator down and then goes steps up, right? So you had a negative, and if it goes too much up, then it kind of, again, it's corrected. And this environment is more like mean reversion, right? You have mean reversion, and to avoid that on shorter scales, on say 1 week, right? So if 1 week is positive, next week is most likely to be negative, and so on, across almost all asset classes. And this is difficult condition for trend following, because what you want is market persistency, the statistical persistency called positive autocorrelation. So this was one part that I found interesting. What was maybe unusual or
real quick on that, did you get to a reason of why that changed? Was it right? Some people say the space got too big, there was too many assets chasing too few contracts. Others have argued against that, saying that the stats don't really show, like the price action, you could say, but the volume stats don't really show it.
Yes, well, I'm a mathematician, so
yeah,
I can answer in mathematical terms. The nature of market changed. Before markets to be more like there was more this positive autocorrelation, what I call that.
Yeah.
Probably it was a slow propagation of news, right? It would take a time that market would converge to equilibrium through several steps, through several weeks, or several days, several weeks. And therefore, by say kind of early discovery, you would be able still to participate.
Yeah.
And nowadays, especially over past decades, right, it's more like this kind of mean reversion where the news propagates very fast, market corrects very fast, and then the rest you have like kind of this positive trend, but it's not because it's positive, right? There is, say, QE programs or people getting into equities, right? This kind of not something that you want, right? Something persistent. Right?
It starts to become more binary, just right. There's some new shift that just shifts the market from here to here, and then it's chopping along here. So yeah, that's interesting. That's right around the time the internet, obviously, then social media, then computers. So right, everything was just getting faster in terms of the market moving, news propagating, high frequency trading firms. So for you, not because trend following got too big, but rather the rest of the players got too much information too
efficient, too fast, too efficient. Trading, especially in commodity markets, there is informed traders, right? There is bigger trading houses that could adjust very fast, much faster than, say, traditionally it would be, say, more clusters of smaller traders that would take longer time to adjust. Nowadays, you have few concentrated players that could move very fast in a way that is not tradable by like CTAs.
But so then how do you explain the recent performance and how they keep going, right? So because they've lengthened it up. Yeah.
Again, it's a narrative, right? It's we waited for a long time and trends were very good. It's a perfect environment because I think rates, 10-year USD rate, it was last August, it was 1.2. And then it went almost like this straight line to now we have 2.7, right?
Yeah.
So it was 1.5, like it's really, and correction didn't last more than 1 month. So it's a perfect environment where you get like increase. This is exactly what you want for a trend following. You increase shorts, and it goes your way.
A little bit at a time, you can move your stop up.
Exactly.
Yeah.
And also with oil was very good. It was very good combination. Also oil and oil also. I think the trend really strengthened mid-October. Right, we were under 60, and end of February it was 130. And actually, and CTS I think were long. I would say November, December. You didn't wait until 130, right? And after the correction, I think actually most of the guys must be flat. And it was also good in terms of, say, portfolio diversification. When the correction in oil happened, right, rates went up. So actually,
it was
very smooth.
Do you have any thoughts? I've long said on here that a lot of trend followers went long bias, added more equity beta, right, exactly, to survive, because it was such a long period of nothingness that they had to do something to survive. And now those programs are kind of underperforming here.
Exactly.
Were you tempted in your research to say, hey, if we just made long bias, it would work a lot better?
Well, so the part that I know from other sources, I can tell you. So part of research, what also important framework I developed was carry. Right? It's and I tell you why it's important. So for futures, carry, say for bonds, is very important. Yeah. Carry, carry. The one that if your return from backwardation and contango. So when commodities in backwardation, it means there are economic benefits of holding the asset. So for example, for bonds, if it's, and also commodities are always excess returns. So if I buy, say, 10-year treasury bond on a margin, I get the coupon that my carry is rate carried. I get the coupon and I pay funding rate.
Yeah.
For me, it's beneficial if funding rate is 0, right? And I buy 10-year coupon at 1%, I get it. The second important component is roll down, because I'm constantly changing my contract to 10-year future. And if slopes are in rising, right? If market expects rates to rise, but actually nothing happens, right? Say in 1 year, 10-year bond will be at 0.9, right? So I get 10 basis points multiplied by duration, right?
Yeah.
So this
but that's what was happening for the past 30 years almost, exactly, right? There was always expectation of higher and it never came to be.
But actually, this is surprising part. A lot of people, that people, like, you have to understand fixed income. Actually, with negative rates, German bonds were the best investment in your CTA portfolio.
Yeah.
And the reason
19,
that, yes, even before that. So especially say 10-year was, or 5-year. In the end, you pay excess return, right? And if your funding rate is minus 75, but your coupon is like 50 basis points, you get the spread of 25 basis points, right? Plus, if a term structure, right? So you bought it at, say, at minus at minus 50, but then it moved to minus 75, right? You get this duration, it declined.
More negative.
So actually, and plus, because we are almost everything is on risk basis, right? Volatility was very low. So the component, say, carry component of bonds, of short dated, say, both were more than 1. So Sharpe ratio. If I just buy bond at negative rate, I hold my expected return is Sharpe of 1.
Whoa.
Right? On a risk adjusted.
There's a lot of money being spent on stuff more fancy than just buying.
Yes. But it means also in commodities. So similar in commodities, a lot of stuff that say right now, right, it's always some sort of deterioration, right? Right now, short-term supply is is affected, right? So short-term people expect higher prices, but lower term lower. So we have backwardation, right?
Yeah.
What actually also most of the time is actually if you buy now, say if nothing happens, right? So you get this carry component, right? And this is for many commodities. It's always economic thinking thinks this, that all producers, once they see higher prices, they would like supply the market, right?
Yeah.
But it's never like this. It's
that
never
easy.
non-linear. And usually, so carry also in commodities is important component. And then we come.
Sorry, go ahead.
And then, so what brings us to trend following is that over time, say in 70s, 80s, if you make a breakdown of your P&L, how much you actually got because prices changed, or how much you got from just getting the carry component, right? That since didn't change, and you just get your coupon or your backwardation in commodities, actually 10-20% in early 70s, 80s, 90s. Right now, over the past decade, over especially last years, it came to 40-50%. Right? Say prior to the last year. Say
so 70s and 80s, 20% of the profits were from carry, and 90s and 2000s, 80% of the profits from carry.
No.
Vice versa.
90s were still 20%. So
okay, well,
90s were 20, 2030s, 2010s 40%. Right?
Got it.
And this is the reason, exactly as you said, two components that holding periods increased. Right? And maybe not many CTAs even realize that you benefited a lot from, like, past 10 years, most people were long bonds, and bonds didn't. Okay, there was, of course, they benefited from fallen rates, but it's not as big as say benefiting from this carry effect. Like
more so benefiting from poor estimates on what the future would be, on that rates would be high.
Exactly.
And so what do you make? Have you seen Roy Niederhofer's research on that? If you flip the chart, right, if bonds go on a 30-year rising interest rates, because of this carry, trend following might be flat to negative, right? It's not necessarily. It's not necessarily going to make the same money. Have you seen his piece?
No, but I see the reasoning, and I tell you, in my actually why I'm positive now on trend following. As I said, I did a lot of long-term studies. In 70s, late 70s, early 80s were the best time for trend following because they were short. They were both short equities and bonds. And the reason is right now, actually, a carry effect is not very strong because term structure are flat. It's actually the opposite. If, for example, so if I have, say, now slopes are negative, I'm actually benefiting of being short.
Yeah.
Right. So, but being said that, it's always, you have to be careful, right? With trend following, we say, I prefer to keep it as pure as it is, and for me, carry is a second order effect, right? But it's important. It's important to maybe adjust positions or understand what are, say, drivers of returns. To his point, that it would cost when say you short long-term bonds and your current rate is still very small, right?
Yeah.
You would lose on this coupon carry, right? There is not much of roll down. That right now is term structure is flat.
Yeah, which we could see in 5 years or something, maybe short terms at 2% and longer terms at 10% or something. Yeah. But now, right, we're basically flat. Or twos are above 10s, again, right? Yeah.
Because bonds are futures are excess returns. So if say short-term rate goes to whatever 5% and 30-year bond yields you 5% and term structure is flat, my carry is zero, right?
Yeah. So then it's just the price action.
Yes, exactly. I'm not that's the difference, that I'm not short in say cash bonds. In futures, you always on excess funding rate.
And so part of your leaving Quantica that there wasn't enough to research and trend? Did you get bored with the trend research? Right. It seems like there's only so many ways to skin the cat. You can do a bunch of moving averages, you can put a bunch of filters on, but there's not like a blue ocean of new things to research there. Is that right or wrong?
Well, I mean, I think CTA has survived, right? Since it's probably the oldest quant strategy out there. A lot of equity, like this kind of mean reversion, it didn't survive, right?
Yeah.
And I think partly it's because it's very conservative, right? But there is a lot of things to do. So some part I mentioned also, what I think most interesting are part of say traditional price-based trend following was sentiment data. And so sentiment, you know, that you heard that some people applied it for stocks. What I found interesting in my application, that you can also trade say global futures, or say US based futures, equity, bond, commodities, based on news flow, right? And news flow, in my opinion, so since nowcasting, it has been a new word since Corona crisis. Reason that traditional models, they need to take some time. So quant models, you need to observe the phenomena. You need to say train. You need to think how I translate say this phenomena into actionable ideas. How I build my model, how I back test it, and how I put in production. And so, of course, it takes time. With sentiment, what we observe intuitively, say, each news, economic news, for example, unemployment numbers, right? If you expect that in certain regimes, a bad number is a good number. In some sense, like right now, I would say bad number would mean that the Fed is on pause, so actually market would benefit, right? Before crisis, say, no one knew the extent, right? How deep the economy can contract, and therefore everyone would expect that bad number is a bad number. Next time it will be even worse. And this type of system where you have different news, right? So imagine you have different sentiment. You can track, say, news related to unemployment, news related to COVID, to oil supply, to wars, to everything, and you can create a continuous time series, right? That would say maybe you can normalize, so it would be almost like a scores, right? So negative score would mean that this news feed right now is very negative.
Yeah.
And then you study impact. So a little bit of machine learning. We try to select factors that actually drive right now the market. Right? Right now, everything that relates to Fed right now would drive the market. Anything relates to war, right? And
the trick
and
there
that's
is
it.
how do you know when it switches, right?
Yeah, so it's a short-term. It's a short-term system
Yeah.
where you constantly update your say model, maybe week, every month. You just try to select factors that matter most, and also their loadings. So
And-
this is a perfect. What I like it's statistics. It's first of all, for me it's a high frequency. It's not high frequency, high turnover.
Yeah.
High turnover strategy. It has very good defensive profile. Right, it's almost like being long volatility. It's very sensitive to transaction costs. But what I found interesting is, for me, it's some sort of trend following on news, news sentiment, and
That's
it
cool.
can be made to work.
Right, and basically long and short, the same piece of news at different environments.
Yes, and this is also what people were calling nowcasting. I think term become popular, but yes, I come up with a model at least in say that I like it.
And what do you make? I can't remember the authors of the paper, but there was a paper about a year or two ago talking about as soon as a factor is identified, it actually ceases to be a factor, right? Like the very fact that you've identified it and put it into the market, other players have done the same work and identified it, put it in the market, and it ceases to be, kind of value to drive the alpha that you thought it could drive. Have you seen that in real
Yes.
practice?
Well, fortunately, not probably in my case.
Yeah.
I can tell it's always question is always what kind of factor, right? So say so most of academic literature, especially factor, it's very simplistic way. It's you find some sort of whatever fundamental or some sort of behavioral factor, you sort of build your rankings, and then you put like some kind of dark testing, right? Whereas we go, say, for example, and it's of course, I mean, first of all, is obviously if there is something that you come up, like say, okay, it's academic, you would anyway expect that people profit. If it has value, it's a natural that it will disappear because people would profit. In more, say, in our systematic trading, I mean, everyone knows what CTA is, right? Say, for example, CTA is. But there are so many different layers. You cannot actually tell that it's a risk premium. It's a dynamic strategy that is more, say, the values from rules, from applying the rules and from harvesting the beta. So
And
for me, it's more like
with sticking to it, right? The values from enduring. So you mentioned risk premia. You were at Julius Baer doing risk premia, right?
Yes, a bit everything.
So dish the dirt for us on the pros and cons of risk premium strategies. To me, sometimes a little too simplistic. And like we just talked about, if everyone rushes into one on some bank platform, it's likely to stop working. What are your thoughts?
Well, risk premium is because we have say fundamental factors like probably valuation. We have structural, like say short volatility, that say is more demand imbalances. In my opinion, you have to be very clever how you implement it. Right? It's a strategy for good times, in my opinion. You can build a well-diversified, say, portfolio of different risk premia. What is good, probably risk premia, you have always expectation, right? Always say, like simple cash and carry arbitrage, right? You buy or short the future depending where term structure is, and you buy and sell spot, right? And of course, problem is inversions. So with carry strategies or with say risk premium strategies, most of them you make money 80% of the times, 80, 90, right? The problem is that those remaining 10%, they actually can invalidate any return that you made. So therefore, I believe that a lot of this stuff exists, like say short volatility, is because it's difficult to over time, right? You have to be there through worst of the times, right? That and therefore, yes, it exists.
But they're like terminal break even, you're saying basically.
Exactly.
So if you access it,
Yes.
make sure you only do it for a certain period of time, but then you're into timing, which is difficult. But sure,
Yes,
but there's
exactly
surely like positive skew risk premium strategies, or no? Or people don't select those because they lose, and then make money. Right? Is there? Can I go on a platform and get the momentum risk premium or the trend premium? Right?
I think for me it's more like say the classic trend following is a dynamic strategy. So it's actually making you trying to replicate this beta profile that works in certain situations. Risk premium for me, it's almost always like some sort of a term structure, right? When say in implied volatilities, if there is a normal period, say of calmness, but you expect something bad to happen, so you're actually betting that these things are not going to happen, right? And you get your coupon, like your excess return, right? So to your point, it's so, and maybe in equities, if you say, okay, there's a value, but the problem is that it's not something that you have to be sufficiently long period of time, right? And if you're saying, okay, if strategy has positive skewness, it means it must realize over short periods of time, right? That and the value factor. So you have like a decay, and suddenly you can have say very sharp return. Most of the risk premium is naturally short skewness.
Okay, interesting. To me, it hasn't fulfilled its promise that was coming out a few years ago of like, oh, you're going to be able to do anything and pull some alpha off the shelf, so to speak. When it's by definition not really alpha, it's some sort of beta, right?
Yes, kind of delayed beta.
Yeah. So let's move on to vol trading. You had your delta hedging paper way back on. We've had some debates on this podcast between different episodes of some people, right, who are basically saying the gamma, the delta hedging, that's what the whole game is in the S&P. And if you're not cued into where those levels are from the dealers, you're not gonna do so well. And other guys saying, yes, it's a factor, but it's very small, right? Maybe it's moving the S&P points at certain thing, but right, it's not causing it to move 50 handles or something. So take us through what you found in your paper and what your thoughts are on the whole dynamic, especially currently as options volume has exploded and whatnot.
Well, so I tell you my background. So with vol, so first I was working for desk that who made markets in emerging market equities. So and that it's OTC, big size, and liquid underlines. And where that idea came from, that you really try to look at your risk and how much it would cost you to hedge. So that origin of that paper. Now, and of course, flows are like on OTC market, flows are important, but they are one way. It's only the dealer dictates the price, and you can always say, you always can say put your spreads high, but moreover, to the point, yes, your positioning creates feedback loops, and they are very strong. And most of the time, yes, it depends. how clients positioned, and how that definitely would create a very strong feedback effect. Right, going to S&P, I doubt. I think its market is too deep, and it's more positioning of market overall that matters rather than position of several dealers. Like, for example, what we had in February 2018 when Volmageddon.
Yeah.
That it was market was, everyone was short vol, right? So I don't know if what dealers, yeah.
Yeah, you could argue the S&P didn't really move all that much, even though vol exploded up, right? So
yes,
it
was position of market, but some people believe in these levels. For me, I think I thought this was more like, definitely flows are important for say, especially on a loan side, right? Like most of, for example, or traditionally, especially private banks, where clients are typically short volatility, so they sell through structured products to the bank, long dated options, or in return to some sort of kind of coupon, right? A problem, but it's almost everywhere. Even though you can buy it cheaper than you would say go in listed markets, right? You are long volatility, and you have this carry decay, and you need something bad to happen in markets, right? That you need that flow. So to be long volatility, you need to be attached to a good flow of cheap volatility.
Of your client's flow that's short the other side.
Yes, exactly. You cannot just buy on markets. Like, for example, I would not assume that you would be able to profit systematically from being long S&P options unless you incorporate some sort of other information.
And what your VIX blow up paper as well, what was the conclusion there on those products? We're having vol shares who just launched the new VIX ETFs on either the week after or the week before you, but what are your thoughts on those products? Are they useful tools? Are they dangerous?
I think they are very dangerous, because especially for retail, I mean, professional players, they would implement anyway through this kind of term structure. They would not be, of course, it's how they would have, you have to manage your margin call, right, or margins. But here it was product that was just wiped out, right? Like, you just wipe out of equity, and I think, yes, people discuss it was a feedback effect, because it closed. I think the reason was that it closed the end of the day, right? And price declined, and dealers, like well-known Swiss banks, they had to liquidate their their short position in a 15-minute of period when markets, like, cash was closed, futures was open, and that really created some crazy liquidity effect that product blew out.
Right, and
I think so.
Go ahead.
Statistically, I think it was high convexity event. That S&P dropped like -4, -5%, and VIX almost double.
Yeah, right, because of those flow effects, and because in the prospectus it said they'd have to exit, right, if it was below a certain level. That seemed to be the biggest mistake. But at the same time, they wanted to stay solvent, right? So they had that language in there, so they had an out instead of going bankrupt. And then what have you done any modeling on the VIX itself? What do you see as the challenges on like doing quant work on the VIX? It seems like its own animal there.
Yes, indeed. I did some quantitative and empirical work. I think the most interesting aspect is relationship between puts, S&P puts, skew, and VIX, right?
Yeah.
And sort of VIX calls skew, right? So it's more or less the same function. S&P tanks, right? You can be, say, long S&P puts, but also long VIX calls, right? So this is interesting. Another interesting effect is, so this is more like a skew.
And that ratio should be the same-ish, right? But you're saying it gets dislocated, it gets out of whack?
Yes, typically, as a second order Premia, VIX skewness is steeper than, say, two. That opens up, say, opportunities like, say, arbitrage, right? You would be short VIX calls and long VIX puts, S&P puts.
Yeah. Except Feb 18, that would have taken you to the cleaner, right?
Yes,
so the
exactly.
skew's
So
probably there because there's things that can happen where the VIX moves without the S&P moving.
Yes. Another one, so this is more like, yes, this kind of skewness. Another one is term structure. That is like the most interesting, counterintuitive. So when term structure is in contango, so you should sell, right?
Yeah.
Because right, when it's actually in backwardation, right, you should buy, but usually it inverts when VIX is above 30. So this creates some sort of interesting strategies where if VIX is above 30, you would buy it. You would buy, even though it's not cheap.
Yeah.
But say expectation, it's again, if not the carry-based sort of
you buy the future because the cash is above the future. You're saying.
Exactly, yes.
Even though it's in
if nothing
contango,
happens,
right? Yeah.
Nothing happens, you are long volatility and you get the carry, right? This is ideal. Right. It works few times in past, but it's again, it's not tradable. It's interesting, but it's very hard because we're really looking at handful of events that where it would work, and it's all the time it's so much conditional on, say, your rebalancing, what future expiry you got.
Yeah.
But this is definitely interesting, I think, and I know that some people they do base, say, strategies where looking at the term structure of VIX, you would, say, trade one way or another with S&P, mixing S&P options, VIX, and probably VIX options.
And then do you tie in a little bit of machine learning? Like if there's so few of those big spikes, right? Like how do you do any valuable backtest or research of, right? Do you have enough data on those big spikes to make it statistically significant, your research?
No, that's the point, that you cannot make it's really like, I saw in backtest of this kind of long volatility. It's really, you make money at 2 or 3 points, right? And therefore it's always this strategy. You need to look at robustness, right? So somehow, if you want to do something like that as a standalone, it will not work. It should be part of more, say, broad, some kind of how they're called, tail hedge.
Yeah.
Actually,
or just a long equity portfolio. Yeah.
Yes.
Okay, let's move on finally to your new gig at Sygnum. Am I saying that correct? Sygnum?
Yes, Sygnum.
Sygnum. So tell us what you're doing there, why you joined, and all the goods.
Mm-hmm. Well, so I actually, part of my decision was a new book. So I have a bookshelf, and there is some mathematical methods, expected returns, so risk premia, active portfolio management, and then there is a new one that is blockchain and distributed ledger.
That's
that
your
was
book?
issued. It's not, unfortunately, not mine, not yet at least. It's Alex Lipton. He was previously he was global head of Quants at Merrill Lynch, at Bank of America Merrill Lynch, and we worked. He was manager of my managers, but we had still very good relationships. And I saw he moved to blockchain like a few years back, and then I was following here and there his publications. Last year we decided to start to work more closely, like DeFi applications, so automated market makers, stuff like that. And so I kind of got interested. I still have, say, my reservation about where all this thing go, but it's interesting. It's developing fast. And when I saw opportunity at Sygnum, I already had some feet in this area. I said, okay, that's it. I should go.
And they're Zurich based there?
Zurich, yes. So Zurich is a digital bank. We do a lot of things like tokenization, custody, but also sort of traditional asset management.
So digital banks, all crypto, or has some fiat, has good old fashioned francs and dollars as well?
Like you can hold cash, but all activities are devoted to crypto.
Got it.
Especially on the investment side.
And so we just talked about the craziness of modeling VIX. Now take us through the craziness of doing some quant modeling on crypto.
Yes, that's a perfect. Yeah. Unfortunately, I cannot share my screen, but I tell you one. It's very interesting. Say piece of figure that I want to show to everyone.
Yeah.
So part of my role, I created a database of all tokens, all protocol tokens or coins that were traded, right, over time. And
traded anywhere, any place?
Traded anywhere, yes. So we work with several data providers. So they all have this data. It just a lot of stuff changed over time. You have different names, different tickers, but I did work and I have more than 5,000 different stuff that traded. Moreover, the stuff had volumes that volumes are non-nonce that and market cap. 5,000. 2.5 still active. Active in crypto meaning that there are still some activities. The protocol can be dead, right? So most of the time it goes up, it spikes, then it goes down to say whatever 0.00 something. But because in crypto per se there are no listing requirements, so since
it sits there,
can be there. So in my data set there are 5,000 sort of dead stuff in 5. So 5,000 total. Half of it, it's kind of just disappears. Probably was not economical even. To keep track of them. 2,500 are still, even though some of them don't trade frequently. Then what I did for each of them during the period that they were live, I computed the maximum drawdown and the PA return. Just right. And if I plot, my X is a drawdown and my Y is PA return, right? So you understand that drawdown, usually if things goes minus 90%, say drawdown, minus 95 is no way to get back that you need like 1,000x returns, right? That doesn't happen. And of course, then your per annum return also is negative. So actually, you would be surprised how much things are in lower quadrant with drawdown more than 90% and effectively negative per annum return.
Yeah.
And
So you want to be in the
number
top
is,
left quadrant, right?
yes. So 95% stuff it didn't make through. 95, right? That being that they were legit kind of projects with market cap, with volumes, but they didn't make it through. 95%. Right?
Our negative return and
Yes,
large.
negative return and effectively drawdown. So if you invested $1, maybe right now you would be less than 1 cent.
Yeah.
Even though it's still, you would have it in your wallet, right? But
Yeah.
you would not probably.
But so what does that tell you? Trade these things.
It tells you that
them.
diversification. Nevertheless, if we compute, so of course there are two biggest survivors.
Yeah.
Is Bitcoin and Ethereum. Moreover, if you build sort of theoretically equal weighted portfolio, right, that you invest in all tokens that have available market cap, you would actually decent return. So like it would be of course risky, but say we would be talking of maybe 200% annual, right? Which is decent,
even with
right?
the 95% failing.
Yes, yes. Wow. Because few of them, right?
Yeah.
There were exceptional guys like more than say 2000. Of course, it's
yeah.
I would not. There was exceptional return, but more. So that would be, for me, it's more like a venture capital, right? You would invest in smaller stuff. You would make money. Also market cap. So instead of just taking equally weighted, we just go market cap. That would also make it through. So you invest in all investable universe, whatever is available at that time, just in proportion to the market cap. So you would also something even slightly better than Bitcoin and Ethereum, not accounting for transaction costs.
But so does that put too much faith in the past, right? Of like, is most of that return in the 15 to 20 range? Yeah.
I think for me, yes, but also it spikes and down.
Yeah.
So what for me tells crypto is all about diversification, especially if you want to go. Okay, you can invest in Ethereum, Bitcoin, probably those are already established, right? The rest, like it's almost like lottery tickets, right?
Yeah.
Don't buy if you think that it's kind of everything will explode crypto industry. No, just go buy lottery tickets. Instead. The same type of it happens faster, right?
And what about trading and what about building quant models to go in and out of them?
Yes. So we're building right now what I think most interesting. What we're building is sectors. And in crypto, it's of course, it's very, there are trends, right? What everyone say beginning of last year was DeFi, then mid of was metaverse, NFTs, Web3. And in my opinion, now also it's much better chances if you select the right sector with proper diversification, you can generate high excess returns, let's say, outperforming, say, Ethereum, right, or Bitcoin. Right? And for me, and what we are building, like it's we're building crypto sectors. One of the projects that I think is very innovative and very interesting. What we're also doing NLP-based classification, because unlike the traditional industry, you have very well-defined sectors like financials, utilities, oil, pharma, and so on, right? And for pharma, you have subsectors, maybe, right? And in crypto, there is nothing like this exists. So people know, say, DeFi sector they can define, right? Like maybe Web3 you can define, but subsectors of Web3 are difficult to define, right? And where what we do is NLP. And
what,
this
what's
is very NLP.
What's your take on Web3? Like,
So-
there's a lot of hot takes that it's kind of a scam and just made up.
Yes.
Yes.
So Web3. I mean, well, Web3 layer 0, what is called layer 0 is Polkadot, ICP, Atom. These are more almost like a foundational layers to create blockchain. So to create a distributed chain of interconnected blockchain, right? And important is that those are more almost like a programs where you could replace the protocol, change the source code, and it would preserve the existing applications, right? As you know, with blockchain, with Bitcoin, you have this fork version. When something happens that algorithm or protocol cannot develop, or there's some very big conflict where it cannot be resolved, right? With say blocks, some kind of either fraudulent or some logical failure that you have to fork. You have to create restart a new copy of your blockchain. With layer 0 avoids it. And it's a it's a platform to create DApps, digital applications. So all kind of maybe DeFi, NFT, gaming, they can be built seamlessly on these platforms. So therefore, this part is definitely the top ones that they will survive, right? That I definitely don't think it's a.
And from an investor standpoint, though, I've heard before, right? Like, it's like getting paid to own the HTTPS protocol, right? Or all of that stuff. So it's similar to that. We're saying you could own a piece of that protocol and get paid every time it gets used. Or is it more programming language that we're just going to build things on?
This one would be more programming language, right? But the protocols themselves that would generate the utility, like the apps applications that build, they would generate utilities through transaction cost. But
yeah, but that seems to be the knock on all this too, of like, nobody wants to pay all these gas fees and all these transaction costs in the new environment. What's the solution there?
Yes, that is the point where I'm a bit skeptical on DeFi on this sense that there is not economic utility yet created for say DeFi. For Web3 in relationship to metaverse, to gaming, NFTs, these things are like say it's a gaming, right? People play to play.
Yeah.
So these are natural. Why I personally actually I believe in metaverse, not say more of this, because it doesn't have a clear competitor in traditional space, right? It's being developed. It's traditional players are coming there, and it creates some need for say these DApps that either some kind of entry point to your universe, to your game, to your collection.
And what's an example of that? Like, I could bring my virtual currency across games or something, right? Spend it in this game, spend it in that game, use it in this metaverse.
Yes. So therefore, there is like several. So within say, so Web3. So Web3, as we talk, it's interesting. Like as I said, we run NLP. So we have NLP being again. So imagine in traditional company, you always have like very big when company like its first IPO, right?
Yeah.
You have everything what they are doing. Once they are up and running, you have quarterly calls. You know exactly what they are doing. In this space, in crypto space, zero, right? You have Bitcoin white paper is 10 pages or 11. This is what they do.
Yeah.
Most of the protocols. But what we created what is called natural language processing, where we would analyze actually textual content of protocols by like, and you can different analysis, like say what words do they most frequently use, right? And that information, once you have that information, you can say build clusters, right? More or less, we can identify, say, Web3, and we can create some clusters. And so, for example, Web3, so layer 0, the one that we said that used to build application layers, the three words that make it different from layer 1, from like, say, Ethereum, and DeFi, like, say, from Uniswap, with all this, is data security and provider, right? So which makes sense. So Web3 is about providing secure data, either storage or exchange or usage, right? For then we go into this chain link, for example. The one that actually use for them specific words are data and Oracle. That being said, they connect different applications, and especially where there's a price information or there's some sort of like reward information, this type of stuff that kind of connects you, allow you to connect different metaverses, right? Or exchange your money through different metaverses. Right, and
I'm lying
then,
that I got it, but it sort of makes sense.
So it's interesting stuff, right? And the best within Web3 was the best last year was performing actually a business to customer, the one that kind of distribute either videos, right, or some sort of information.
But that's a company or a token? Or a coin?
It's a sector. I call it more like a subsector. So
but those sectors are made up of the coins, not the companies.
Coins, yes.
Got it.
Okay, strictly speaking, is DAO, decentralized autonomous organization.
Yeah.
But for me, it's almost like some sort of maybe startup, or those are things that they have valid say application, right? They have valid white papers, developers.
Right. So it's your whole point of coming back to it's the VC world, the digital VC world. Who knows who the winners are going to be? Choose a sector.
Diversify market cap, either volume, market cap, a lot of it, especially biggest challenge for building a systematic solution is really data. I spent much more than I imagined that I want to. Data on cleaning, on understanding differences between different providers.
And there's no standard for like their APIs to pull the data. Yeah. So you're in the Wild West there. And then how many exchanges are there that you've identified?
Trading application is another thing.
Yeah.
Usually I would always, fundamental data is important. At least this kind of say screening, that at least there's a white paper, you can compare it, you can identify it, then you have market cap that some protocols actually they may overstate, understate. So you need to have different ways of comparing actually outliers, right? Picking outliers, then accounting for volumes, especially once we build up a scalable asset management solution.
I'm going to let you go here, but I need to know first what's on your shirt. Looks like some math.
Yes, it's actually, I wanted to be for this. I like it. It's from Stern. It's just some formulas.
Just some formulas. I thought it said Jeff for me. I see a lot of F's on the top line.
Okay, well.
The fair market value.
I think it's from physics, so it's a force or something like that.
The force, mass times volume. Yeah, or mass times velocity is force, right?
Yeah.
We'll show our lack of physics knowledge here. And then I was going to close with our what would you invest in, but you sort of answered. So if you got $1,000 crypto edition, $1,000, where are you putting it?
1,000. So 1,000 it's. I mean, it does go with Ethereum. That's it.
Ethereum.
I mean,
All
with
right.
Bitcoin, you probably want max for your buck. So I think Ethereum will outperform Bitcoin.
And now if I 100x that, so I'm 100,000.
100, then I would go a little bit more like, say, sector based or broad market, but a little bit with like what I said, some fundamental ways, even as simple as market cap. That you don't need to rebalance frequently, but it's definitely worth to have more diversification.
And then so at $1 million, same thing, just larger numbers.
At million, yes, I would do the same. Would try to build up a diversified portfolio of token exposure.
And then 100 million in
100
crypto.
is
Does
very
that scare you?
interesting.
Yeah, that scares me.
That's a good. So actually, that I would this. For example, at Sygnum, we actually have different pockets of investing. So we have venture capital. So of course, part of should go. Venture capital is the highest risk, highest return potential. Mm-hmm. Then we have, say, fund of funds. We are also building up systematic strategies that say, but most of the stuff, say, to invest in crypto, you need to have long beta exposure. You cannot do shorts. Right? It's not a market that where you would benefit. So that being said,
really, even with the past 2 years and some of these drastic spikes lower,
no.
Too hard
it's
to
difficult,
grab.
Difficult to short. First of all, you can only short, say, safely is Bitcoin and Ethereum. The rest are very hard. Right? It's not, say,
you'd be paying 80% borrow rate or something. Yeah.
Yes. So going back to fund of fund or some systematic strategies, we also have yield. So more some sort of arbitrage, right? There are different ways, either staking, also like arbitrage, say cash and carry arbitrage, which more or less the same, and also some beta, like pure beta exposure.
And so last bit on you mentioned the staking and the yield farming, like, is that even further afield than traditional finance, right? Like the coins are one thing, but that seems to be, what are your hesitations there? What have you seen that scares you there? What excites you there?
Mm-hmm. I think, so what excites you, of course, they offer rates higher than, say, traditional finance. Although I think definitely it's a protocol risk, wallet risk. So those.
I mean, it's an unsecured loan, right?
Yes.
So that's the arguments against is like, hey, you could do an unsecured loan on people's cars and stuff and get high rates also. So it seems to me some of the arguments against are you're getting unsecured loans at rates lower than they should be.
Yes.
But we'll let people argue that one. All right, Artur, any last thoughts? You're on Twitter there and your blog post too, right? Tell everyone where they can find you.
Yes, people can find me on Twitter. I try to be active. I actually nowadays I think there is a lot of useful information, right? And yes.
Yeah,
drop me email.
I'll do what's your Twitter handle? We'll put it in the links too.
Artur Sepp.
All right. ARTUR SEPP.
Yes.
Quick, I went down to the office yesterday, which is near the Board of Trade there, and I parked in what's called the Traders Self Park. It's from 40 years ago, right? Where people would trade when they went to the Board of Trade and did the hand-to-hand combat trading. So the elevator buttons are all like gold, wheat, T-bills, euro dollars, right? All the floors are named after futures trades. So I took a picture of that and tweeted it out, and it's like going on 3,000 likes. I'm like, I'll put out some well thought out thread or something intelligent, and it gets 2 likes and one retweet. You take a picture of an elevator buttons, and it gets 3,000 likes. So Twitter's a weird place. Not that anyone needed to know that. And then what's the blog?
Yes, and also my blog. I forgot. So I think as we spoke a little bit at the beginning, for me, quant research is my passion. So I really separate. There is my profession that makes something that creates, say utility, but I also, it's more like a passion where I spend more time, say, understanding how things work. So using either maybe more technical stuff or maybe more something beyond. And of course, I try to keep the blog. There's a lot of, say, my older academic stuff, some almost like memoirs on quant and systematic trading, but also new stuff is coming, especially on crypto. Right now we are working on very interesting work. It's more, say, academic, of course, academic, like not academic, it's like the modeling flavor, but it's crypto, we didn't mention it.
What's the URL? We'll send people there. We'll put it in the show notes, but tell the listeners.
My website is also artursepp.com.
Easy. You got the best ones. It's nice having a unique name, right?
Yeah.
All right, Artur, thanks so much. I'll let you go enjoy your evening there. My last question, Jeff, when you moved your head, I saw a picture of, is that your kids in ski goggles?
Yes, exactly. It's,
nice. Where do you ski?
With my wife. Well, we ski, I mean, it's lucky to be in Switzerland. And we regularly go skiing. Actually, our son now is 6 years, and he's perfect skier. I never expected that I would be able to ski with my son. So, like, say, when he's 6, right? And
that's my main goal in life. I keep in shape just so my son's 13 now. So he's almost fast for me, but I want to be in shape for when he's 18 and going down super hard stuff, and I got to keep up with him. So,
well,
that's my motivation.
Keeps you
all right.
going.
Well, now we got to get a trip out to Switzerland to ski together. We'll bring Bastian along. Get a little quant ski trip going.
That will be great.
All right, Artur. Thanks so much.
Thank you, Jeff.
Soon. Yeah.
Ciao.
You've been listening to The Derivative. Links from this episode will be in the episode description of this channel. Follow us on Twitter at RCMAlts and visit our website to read our blog or subscribe to our newsletter at rcmalts.com. If you liked our show, introduce a friend and show them how to subscribe. And be sure to leave comments. We'd love to hear from you. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of RCM Alternatives, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations nor reference past or potential profits, and listeners are reminded that managed futures, commodity trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors.